In this video, I'm going to demonstrate concepts of CVP analysis, operating leverage, and margin of safety using problem 355 as an example. We're going to be a training company, and part of what we incur is recorded lectures, and we're trying to determine, what arrangement should we use? Should we use a revenue-based arrangement that we would pay 25% of revenues, so that would be a variable cost, or should we instead use a flat rate of 390,000 and that would be a fixed cost? Before we consider the royalty costs, keep in mind the revenue that we earn per seminar is 1600 and the variable cost, not including any potential royalty fees, is going to be 300. And the annual fixed cost, again, not including any royalty fees, is 585,000. First part asks us to calculate break even. And I hope you're already familiar with break even per unit or here per seminar would be fixed cost divided by contribution margin. So let's think about what's contribution margin before we even consider royalty fees. Well, that would be the 1600 in revenue minus the 300 in variable cost, again, excluding any potential royalty, is 1300. So let's jump back into our revenue-based royalty agreement. The fixed costs are 585,000. We don't have any additional fixed royalty fees for the revenue-based arrangement, but our contribution margin isn't going to be 1300 now. We're still going to have revenue of 1600. We're still going to have the variable cost of 300, but now we need to subtract out the 25% of the revenue. So 25% times 1600 is we're subtracting out an additional $400 from that original contribution margin of 1300, brings down our contribution margin to $900. Divide that $900 into the fixed cost of 585,000 and we have a break even revenue. We need to sell 650 seminars to break even under the revenue based break even analysis. Compare that to the flat rate. What's going to change? Well, the fixed cost is going to change. We're going to start with the 585,000 that's there irrespective. Plus we need to add the additional flat rate of 390,000, bringing up our fixed cost to 975,000. Again, divide it by the original 1,300 in contribution margin because we're under this arrangement, we're not paying the additional 25%. And I'll let you make that calculation of what the number of seminars would be under the flat rate break even. Part B, I noticed that often a lot of students struggle. It asks us at what annual volume would the operating profit be the same regardless of the royalty option chosen. Again, I'll get you started with this. We're just going to equate both formulas for operating profit. So let's take a look at this. What's the operating profit formula for the revenue-based royalty? Well, I can shortcut this. I can say it would be contribution margin per unit, which we already saw before. I'm not going to walk through that. That was $900 times the number of seminars. That would give me total contribution margin dollars. The only additional thing I have to subtract out to get profit is the fixed cost. Again, we already said that's 585,000 for the revenue-based arrangement. If I equate that to the operating profit formula for the flat rate, and again, we're going to go back to our original $1,300 because we don't have that 25% to subtract out, times, again, X, the number of seminars that we need to sell. That would give us total contribution margin dollars, minus the fixed costs. Also under the break even, we said we had to add that additional 390,000. So this would be 975,000. I'll let you do all the math and rearranging, but I can solve for the number of seminars that would equate profit for both. The next item I'm going to go to is C. So we're asked to do a number of calculations in this problem. It asks us to calculate operating leverage. Now, we in accounting aren't too creative with our names. Operating leverage, a lever is something that applies additional force. Operating leverage creates a multiplier, an estimate of any percentage change in sales, how much that's going to multiply our percentage change in operating profit. And they want us to know what's operating leverage at 1,500 seminars. What's our formula for operating leverage? It's going to be contribution margin dollars in total. So I want to stress, not contribution margin per unit, but contribution margin in total divided by operating profit. So you can see here under the revenue-based agreement, we've said before, contribution margin per unit would be 900. We're talking about at the 1500 seminar level, so we'll multiply it times 1500. That would give us contribution margin dollars of 1,350,000. Divide that by our operating profit. Again, we've already shown I can shortcut that by taking our contribution margin per unit of 900 times 1500 seminars. That would give total contribution margin dollars. We also solved at the top 1,350,000. Then subtract the 585,000 in fixed cost, and we're going to get operating profit at 1,500 units under the revenue-based arrangement of 765,000. 1,350,000 divided by 765,000 is going to be an operating leverage of 1.76. Again, it's a multiplier. So if we had just a 1% change in sales, that would create a 1.76% change in operating profit because of the fact that we have some fixed costs that end up not increasing in this particular scenario. Now, again, I'm not going to walk through the flat base and give you all the solutions to this, but obviously the calculation is going to be similar. I want you to think about before you do the calculation, would you expect the flat rate royalty agreement to have a higher operating leverage or lower? Think about that for a second. I'd expect it, without even doing the calculations, to have a higher operating leverage. The reason why is the flat rate has a higher component of fixed costs. Fixed costs don't change when the activity level changes. Also think about it a different way. Under the flat rate, because it has a lower amount of variable costs, higher fixed, lower amount of variable costs, recall contribution margin was higher, right? It was 1,300, not 900, like under the revenue-based arrangement. So any additional unit you sell or any additional unit you lose has a higher impact on profitability. 1,300 up or 1,300 down versus 900 of the revenue-based arrangement. So I just assume that this operating leverage is going to be higher. So you prove that out on your own. The last thing you're going to take a look at is margin of safety. So we've done a lot of calculations. Margin of safety is going to ask us to compare what our sales level is now, which they're telling us it's 1,500 seminars, compared to break-even sales. And margin of safety can be positive, it can be negative. If you're above break-even, it's positive. If you're below break-even, it's going to be negative. In this particular problem, they ask us to calculate margin of safety as a percentage. So that's one nuance you want to keep in mind. So for the revenue-based royalty arrangement, again, where am I currently? We're currently at 1,500 seminars. Where was my break-even point? Go all the way back to Part A. We said the break-even for the revenue-based arrangement was 650. So 1,500 seminars minus 650 means break even in units would be 850 seminars. I'm 850 seminars above the break even. Also, I could say I could lose sales of 850 seminars before I get to the point of losing any money. If I want this as a percentage, I'm going to divide it by, again, what's my current sales level, 1,500. So 850 divided by 1,500 is a margin of safety as a percentage of 56.7%. Again, what does that mean? I could potentially lose 56.7% of my sales before I get to the point I'm just breaking even, and then my point would be losing money. Again, you do the calculation for the flat rate royalty arrangement and do a comparison to see if it's higher or lower.